In this lecture, we're going to look at the last main complex area of consolidations, which is consolidated statement of cash flows. So remember, in the last lecture, we would have looked at a foreign operation, particularly a foreign subsidiary covered in IAS 21. And we'll look at what are the rules of what essentially we're calling translating a foreign financial statement, either in dollars or sterling or any currency that's deemed to be foreign, into a euro-based currency. And we're looking there at the exchange differences. And you have four main exchange differences, one to do with net assets, one to do with translating profits, one to do with retranslating goodwill, and one to do with retranslating fair value adjustments. So it's important to practice those. That's probably the hardest area in terms of advanced consolidation. And the last one we move on to now is IAS 7, statement of cash flows. So remember, in your cash flow statement, this has its own standard. And in reality, we're just adding on a couple of additional adjustments to your normal statement of cash flows that you would have covered in your undergrad. So if you have your IAS 7 notes from your undergrad, they can be very useful. But again, we'll give you practice questions in individual company cash flow statements to start off, because essentially there's two elements to this. You need to be able to do an individual statement of cash flows, which is about 60% of the overall question. And then the other 40% will be adjustments around subsidiary, adjustments around goodwill, NCI, associate and joint venture. So that's your knowledge from before reading week in semester 2 as well, and we're bringing those together. So just as a basic recap in terms of preparing a single company statement of cash flows, remember this is a completely different approach than if you're comparing a P&L, balance sheet and statement of change in equity. In this case, you're going to be given the draft financial statements, or the final financial statement should I say. You're going to be given the statement of profit and loss. You're going to be given 2 years of the statement of financial position to give you opening and closing, and you're trying to figure out, can I get the statement of cash flow to work? So it is important that you remind yourself how to go about an individual company statement of cash flows. One of the first things you're looking for is IAS 7 doesn't just talk about cash, it talks about cash and cash equivalents. Now, cash equivalents is important. Watch the definition. They're short-term, highly liquid investments. And in this case, it's anything with a maturity of less than 3 months. So not from the date of the financial reports, it's the overall maturity of the instrument. If the overall maturity is less than 3 months, it goes into cash equivalents. If not, it's a separate asset and you treat it as a separate asset for statement of cash flow purposes. One to note there is a bank overdraft will always be a cash equivalent. So bank overdrafts are always cash equivalents. You'll net them off against any cash, and investments will only be deemed to be cash equivalents when the maturity date is less than 3 months. After that, it goes into just an investment decision, like you look at property, plant and equipment or any other type of asset. That's just the basics looking at your cash and cash equivalents. Within, in terms of classification, you always split the statement of cash flows, like there's a standard layout for P&L and balance sheet, into 3 headings: operating, investing and financing. And what I've given you in loop, if you look at it, so look at your AC571, I've given you an Excel template down here. So consolidated statement of cash flow summary table, and it looks something like this, where I tell you what should be in operating activities, what should be in investing and financing, just to give you an idea of what you'll be looking for when you're going through the question. But it's about practice, no more than a lot of the other questions that you'll do in consolidation. The more of these questions you do, the more repetitive they become as well. All right, so your operating activities, that's the cash from day-to-day operations. That's the cash from the sales and purchases. Nothing to do with financing, nothing to do with loans, nothing to do with dividends, nothing to do with purchase of capital assets. It's just your day-to-day cash from customers, cash paid to suppliers, cash paid to employees. And that's one of the first workings you will do in any consolidated cash flow question, will be get your net cash flow from operating activities. And we'll talk you through the step-by-step of that. But a lot of this hopefully should be a refresher of what you covered in undergrad. All right. Investing then is the acquisition and disposal of long-term assets. So if you're buying property, plant and equipment, you're selling property, plant and equipment, all right? All of those will go into investing activities. So give you examples there. Buying or selling PPE, buying or selling intangibles. Watch these here. Cash payments to acquire equity or debt instruments in other entities, or disposal proceeds from the sale of equity or debt instruments. So if you're buying a sub, the amount you pay in cash would go in here as a cash outflow. If you're selling a sub during the year, the disposal proceeds would go in here. So see, we're starting to layer on now consolidator related ones, that in a consolidated statement of cash flows, you're always either going to get a mid-year acquisition or a mid-year disposal. And what you're going to have to be able to do then is, how do I incorporate that acquisition or disposal into the statement of cash flows? i.e., what impact does it have on cash flows for the group during the year? And the last section then is your financing activities. And this is where you're raising money. So if you issue new shares, if you pay dividends, if you issue new loans or you repay loans, all of those go to financing activities. So it's important just to understand, when you're setting up a cash flow statement, you're going to have three main headings, and leave a couple of lines under each one, that as you find elements that go into each of the statement of cash flows, you slot them in as you go along. So it's easier to gain marks, and that's all around exam technique as well, is being savvy on the day of the exam. Because again, you need to make sure you're going to be under time pressure. So you need to make sure you're presenting and minimizing the risk that you run out of time. So there is some, I suppose, scope within the standard in terms of how certain things are presented. So for example, interest, dividends and tax, there is an element of they have to be disclosed separately, but for some of them they can go in one or two of the headings. So for example, interest received, dividends received, we usually put those in investing activities. You can also put them in operating activities, so there's flexibility there. Interest paid, usually we put those in operating activities. Dividends paid, financing activities, and tax received or paid, just depending on the situation, will go to operating activities. But I said there is a bit of scope there, because you might say, for example, dividends paid, well, technically that's out of the operating profits of the business. Should that not go on the operating cash flows? So there is some scope there, but in general, they're the ones we stick to. But it's not going to be a huge issue either way. The main thing for companies on a year-to-year basis is consistency. So whatever you put in operating activities last year, you must put the same line items this year to allow comparability. So you can see there's two nice examples if you go to the annual reports that are up on Loop. And the Glom BA one I'll just show you as an example. So they have the group statement of cash flows, cash flow from operating activities, and they have a note which I'll show you in a second, note 34. So they made 275 million from operations. Investing activities, they spent 394 million. The majority of that, look at it here, acquisition of subsidiaries. So that's how much they spent on cash to acquire subsidiaries. Remember, if they paid some shares as well, that wouldn't be in cash flow. That would help explain the movement in share and share capital. They also purchased property, plant and equipment. They purchased intangible assets. And if you look down here, they sold property, plant and equipment as well. So that's an inflow. So you have another couple of complicated ones as well. But in general, it's the acquisition or disposal of a sub, the acquisition or disposal of property, plant and equipment, and intangible assets. And then financing, the net financing is 160 million roughly. Of that, they got new debt, drawdown of borrowings is 370 million. They repaid borrowings of 130 million. And the dividend paid to shareholders was 76. So that's why it's an outflow. And the net of operating, investing, and financing is your net increase or decrease for the year. And what the exam or the IAS 7 always requires is this element at the bottom. It has to show you how you got from opening cash to closing cash. And you went from 132 at the start of the year, plus 39.9 this year. And again, exchange differences you won't have, so you won't need to worry about it. But that reconciles to the end of the year. All right, so there's between opening and closing. And you can link that back into the balance sheet in terms of cash and cash equivalents. The opening and closing, and they probably have some down here in terms of their overdrafted they would net off. So that's given in note 22. So it is important that you understand and link all those things together, that the statement of cash flows reconciles between opening and closing cash equivalents. And if you go to note 22, which is here, it tells you what cash and cash equivalents are. So for the group, it's short-term deposits and cash, less your overdraft. So there's your 175, and there's your 132. And when you go back to the statement of cash flows, again, 175 and 132, there's your opening 132, there's your closing 175. So all the statement of cash flow does is reconcile balances you already have. So that's one nice thing you should know about the statement of cash flows is you know the answer. You know what the movement is. You're just trying to reconcile it and show what the movement is made up of. So take a look at that in your own time, the Glambia. And I'll come back to this line about where these cash generate from operating activities in a minute. And also maybe have a look at CRH as well in your own time. Just to get an idea, it's a very standard layout. And of the three complications, disposals, foreign subsidiary, and consolidated cash flows, this is probably the easier one. So preparing then the statement of cash flows, your first step will always be, how do I do the operating activities? And you should remember this, there's two methods, the direct method and the indirect method. Indirect is typically the most popular because it's a bit more simplistic, easier to follow, and you can work off the P&L. But the important thing is both give the same answer. So in some of the questions we do in the question pack, we'll show both ways. You only have to be able to do one. I won't explicitly ask one or the other. You have a choice, and most students will go with the indirect. So the direct method, as it suggests, you look at cash flows directly. So you have cash received from customers, cash paid to suppliers, cash paid to employees, and other expenses, getting you to cash generated from operations, and then interest, tax, and dividends, if you want to, because dividends are optional there, they can go on the financing, are taken off. So why they call it the direct is you're not indirectly working from a profit figure down, you're getting the cash flows directly. So each of these figures will have a detailed working. And what I recommend you do is look at question 1 and question 2. Question 2 has a video up there of working through the direct method. It's a bit longer, it's a bit less obvious, the workings. That's why it's less popular. The indirect method then is you start with the profit for the year. Now you might take profit before tax, you could take operating profit, just depends where you want to start. And then you adjust to get your cash flow from operating activities. So that's why it's called indirect, is you're working from a profit figure indirectly to a cash flow. So there's a number of adjustments then, non-cash expenses. You're going to adjust for non-cash income. So these are items in the profit and loss account that are not cash related. So depreciation, goodwill impairment, profit or loss on disposal of PPE. You adjust for working capital then as well, which are movements in inventory, trade receivables, and trade payables. Right. And then it should look something like this. You start with a profit, you make your non-cash adjustments, you do your working capital adjustments, and this is the figure that's important. That's going to be the same figure here as it was in the direct method. Because after you get cash generated from operating activities, all these are the same. Doesn't matter whether you're doing direct or indirect, they're the same line items. So this is the only adjustment depending on how you approach it. Most students will go like this. They'll do the indirect method because it's the most straightforward and the most intuitive as well. So make sure you take a look at question 1 and question 2 now in the pack. They are individual statements of cash flow. There's a video up there for question 2. So pause it now, look at that video and come back. And just take the lectures in piecemeal bits. So you're not trying to do it all at the same time. And what you should also look at is in your Glambia report, they said cash generated from operating activities was note 34, 316.5. And if you go to note 34, they start with profit after tax. They add back certain items. So they add back depreciation. They add back amortization. They add back, watch here, they add back finance expense and they add back income tax expense. The reason they do that is the amount of finance costs and the amount of income tax in the P&L, they are expenses. They're not necessarily cash flow. When you come down the bottom, which is in the statement of cash flows, you'll take off interest paid and tax paid. So there's a difference there between a tax expense and interest expense and a tax paid and interest paid. For statement of cash flow, we're interested in the actual physical amount paid over to the bank for interest or to the taxman, not the amount of expense incurred. So that's an important difference when we're looking at these. So there are your adjustments, and then you adjust for your working capital. So your inventory, your trade payables, which they call short-term liabilities, or your trade receivables, which they call short-term receivables. And it's important to go back now and look at question 1 and 2 of a full worked example of how to go through that, because again, it is covered before, but you're required to do as part of your undergrad, but it's just you might have done it 2 years ago, so you might be a small bit rusty. A small thing like that will get you very quickly to where you need to be. All right. So the single cash flow is the first starting point. If you want to go back and look at your undergrad notes, that's perfect. But question 1 and 2 should bring you up to speed quite quickly. And hopefully what you remember about a statement of cash flows is it's like solving a puzzle. Remember, you already know the solution before you start. It's the very first thing you'll do is, what's the movement year on year in cash and cash equivalents? So you'll know, has there been an increase or a decrease in cash? And then all you're trying to do is explain, where is that coming from? And if you do it correctly, it will all balance. For some of them, it'll be very straightforward. But for other complicated line items, like property, plant and equipment or retained earnings, you may want to open up a T account just to see, can you track all the movements? And the plug figure then is always going to be the cash flow item. So said, it's easy to talk about it in generic terms here. You're better off going to have a look at question 1 or 2 now and saying, right, what am I going to approach this? How do I actually tackle it? And can I do an individual cash flow? And again, if you're struggling after question 1 and 2 and you think, God, I'm still not up to speed, well, what you need to do then is go back and take a look at your undergrad notes or any financial accounting textbook that will have IAS 7 covered, because it's standard across the board. But make sure you've got the basis of statement of cash flow, single company first, because once you've that done, you're only layering on a couple of consolidation adjustments, which you've covered in a lot of detail already in the early part of semester 2. Right, so that was the statement of cash flow, just revising the single company. We'll now go on in the next part and we're going to look at, well, what type of additional adjustments will we have when we're doing a consolidated statement of cash flows.